Welcome to Markets Now. I'm Michelle Rook along with Brian Doherty of Total Farm Marketing. And Friday's market closes were mostly lower with the exception of the cattle market. And Brian, in sum total, we had some negative reactions here to possible tariffs on Mexico and Canada that could take place here over the weekend, right?
Well, you did, right. So the question is, how does you're trying to outguess our government and then trying to guess what other governments are going to think and do, and that's a tall task. So you can take kind of a simple approach and say, hey, if this happens, this is likely to happen, and be prepared for that. But you don't know, and there's other uncertainties that continue to creep into the marketplace. In particular, just the weather events in South America. Argentina on the drier side. Reports on Friday were that the rainfall totals are likely to increase in early February. We've seen that same forecast before, Michelle, hasn't really materialized. Crop progress as far as harvest, how fast beans come off, in addition, you've got a higher US dollar this year. So there's just a lot of variables out there. So the concentration should really focus back on looking ahead and asking the what if questions. What if the market goes up a little? What if it goes up a lot? What if it goes down a little? What if it's go down? What happens if it goes down a lot? How do I manage that? What tools should I use?
We have seen some retaliatory talk by Mexico, but wheat was not on that list. Corn was not on that list. Pork was on that list, though. So that is a bit of a concern, and dairy was too, right?
Right, pork and dairy are those are concerns. Yeah, surprisingly, it seems like Mexico kind of wants a very, I'm going to say, carefully tiptoe around the whole corn tariff issue. Obviously, they have a big need for U.S. corn. Even if they had to source it somewhere else, keep in mind you're quite some time away from availability of Southern Hemisphere products. So. I often wonder if that corn just isn't off limits a little bit, but look for all the markets to have some sort of play. Look for uh, continued analysis. It's funny how we see things change so fast in very short periods of time. So it's just very dynamic right now. But I think big picture, ultimately, the world's going to need supply and continued supply, tariffs or no tariffs. So I think the focus eventually moves back to whether Southern Hemisphere production and then U.S. weather. We've got a somewhat colorful drought monitor map that continues to loom a little larger. All of a sudden, we're into late January, early February. We start to pay attention to that a little bit more as well.
What are you watching in terms of technicals in the market that we would take out that would take this market from an uptrending market to a downtrending market? Because we already have kind of a key reversal on a weekly basis on the charts, don't we?
We do. So we've got some hook reversals. We had a bearish key reversal on the weekly chart on corn. So that's when the week's trade activity. You had a new high for the week and a new low for the week compared to the previous week. So you got a bigger range of prices and a lower close. That's not the most appealing signal. On top of that, on the weekly charts, you've got a crossover in stochastics. That's sending a sell signal. And remember the managed money. That is money that's each week monitored by the Commodity Futures Trading Commission. So you get a report out that indicates who the players are in the marketplace. The fund money has been very, very long in the market. So we'll look to see if they start to liquidate contracts as well. And the very near term, the day to day contracts, look at the 10-day moving average, has held very well now for 2 months. If that's violated, then that adds more fuel to the fire for the bears. So there are some technical things that are floating kind of big right now, need to be acknowledged, and then we'll see what the market does in the days ahead.
What's your thoughts about soybeans? The funds are not as long there. We still have a big Brazilian crop coming, but there have been some issues in South America. Where does the market go? What do we have priced in?
Yeah, so right now you're looking at beans in let's call it the 1050 area, and that's a substantial increase of where the market was 6, 8 weeks ago. Has factored in some weather concerns. Exports are beginning to slow. That's typical for this time of the year. So the thing to watch in South America is, will there be continued rain delays in central Brazil where they're trying to get the crop off the field, and that too can affect corn because that's where they follow up with the second crop, safrinha corn. So, watching that region of the world, Argentina has stayed continuously pesky dry. That is, you've had pesky dry weather, scattered showers, not enough blanket coverage. So, the market has found support from there. The only thing I'll say there, though, it's still early enough in the season that if that forecast, which many are looking for more rain, if that does materialize, that too could be a negative detriment to price. positive for bean production. So a lot of things to watch in that southern hemisphere, in addition to tariff talk, in addition to technical analysis.
Although from a tariff perspective, soybeans did not react as negatively as maybe corn and wheat because what? We're more concerned about China tariffs there or what?
Well, they could be. I think we need to take one step further back and look at it and go, well, we're not expecting China to come in and buy U.S. beans in droves. The world's, in theory, awash in soybeans. So China has choices to begin with at cheaper product elsewhere. So I'm not so sure that that's necessarily a big play right now. Where it does become more and more important is if South America does have some weather problems that make production more impactful, and therefore then attention turns back to the United States for product. But I think in a way, just supply alone is already an issue in the soybean market for U.S. exports, whether it's to China or elsewhere.
And losses were also a little bit tempered on the idea that we have this big rally in the bean oil market because we might have less imports of canola coming in.
Well, that's another variable. So you've got with tariffs, you've got the potential that less imports of canola, soybean oil marches up kind of quickly, and you look at a market that, when you look at the big picture, continues to suggest that there's the market's in limbo. And what I mean by that is crude oil continues to hold in the low to mid 70s. If you have a shortfall of Canadian canola, the natural impact is go into the US and see US soybean oil move up. However, now the move goes back to the southern hemisphere and weather and tariffs. And so I think it's incumbent to really spend your time concentrating on, how do I shift that risk? How do I stay balanced? How do I stay in the marketplace? There's just a lot of variables right now. This is not cut and dry, not easy. This is very dynamic. And that goes back to the increased volatility we talked about.
You bet. Now, we did have a lower weekly close on soybeans, but we had a higher weekly close on wheat. Is wheat starting to change trend, do you think?
Another variable, wheat starting to change trend and should change trend. We look overseas and we see who's the biggest producer in the world and the export, and that's Russia. And right now, all arrows point to maybe the lowest crop production in 13 or even 20 years. Roughly 35 to 40% of that Russian crop is considered in poor shape. So there's a basis for prices to hold support, but it's worked really well for traders to buy beans, sell wheat, and we saw reversals of that. And you're seeing some really friendly technical signals in the wheat market there again, with bullish key reversal on the weekly wheat charts. That'll grab the attention of investors and traders.
And you mentioned that the dairy market reacted to possible tariffs on especially Mexico. And if you look at a chart, we're kind of in the middle of this trading range that we've been in. And so what happens with this going forward will have a big impact on price direction, will it not?
Absolutely, we're concerned about it because when you look at like butter prices hit new lows for the year on, well, over the last 12 months. We're just into the new year, so you got a weakness in that, way tipped over this week. You've got a big head and shoulders formation. This is a head and shoulders formation on charts that points downward. So you not only have that on the daily charts, but you also have that on weekly charts as well. So there's a lot of foreboding things. Yet, the corrective supply for milk may not come in the form of demand or supply, but ultimately supply of heifers. You've got high beef prices, and the expectation that dairy producers are going to continue to go dairy on beef. So you're not building the herd at this point. Ultimately, consumer demand will determine where we go. But it looks technically like another sort of market. I'd be very concerned, especially with tariffs.
And Brian, we did get the cattle inventory report out at 2 o'clock on Friday, and really, it was as expected, maybe even a little bit bullish.
Yeah, it confirmed, I think, what most all of us had been thinking, that the herd is not building. All cattle and calves, 86.7 million head. That's down a 0.5% from last year. And then no big, there just weren't any big surprises there. Beef down 1%, replacement heifers down 1%. What it confirms is what I think we've been hearing with boots on the ground with our cattle producers and feedlot operators, that supplies remain snug. There's no end in sight as far as, all of a sudden the herd's getting a lot bigger. It's an interesting dichotomy here. You've got cattle futures prices reflecting, I think, already these numbers. Um, but if you're a dairy or a producer who has cows, there's not enough incentive yet to hold the heifers because there's too much cash in hand. So it's an odd economic study that high prices have yet to cure high prices. High prices are keeping calves going to market.
No doubt. So we haven't seen really any heifer retention yet, and that's really the key here for us to think we're going to change this trend and rebuild the herd, right?
I think we're going to be saying we're 51 years now at the smallest herd since 1974, and the interesting part of that is if you look at the U.S. population today compared to then, I don't remember the exact percentage. I want to say it's about 60% more. Uh, it's an interesting study because we continue to argue that from a demand perspective, we're worried about the economies and poor demand, but that 30-40% that is doing pretty well in our economy, they seem to be willing to pay the price for beef regardless of cost. So it's just a strong bull market presently.
So does this help solidify and put support in that market? Because we did not react like real positively, it didn't seem like, to the fact that we had sharply higher cash trade.
Yeah, keep in mind too, the futures market is the futures market. So that is when I look at like an April live cattle. Sometimes I say, oh, cash was higher this week, but April wasn't up or it looked higher. Well, it's because of anticipating the future price in April, not necessarily today's cash price. So as the front month gets closer to cash or cash gets closer to the front month, those two should converge. And we'll likely see that. But from a big picture perspective, you're looking at all-time new high prices and you got to feed the bulls. So even if you get bullish news, somebody has to be willing to buy and take the risk anticipating even higher prices. And sometimes the market just runs out of steam. I'd say that's likely the case in the cattle market right now. There's a lot of risk if you go in and buy higher future prices, only to watch it fall apart. So I think the market's being cautious.
Thanks so much, Brian Doherty with Total Farm Marketing, and that's Markets Now.